Hi, welcome to Market Matters on JP Morgan's Making Sense. I'm John Schlegel, head of Global Positioning Intelligence, which is part of the Data Assets and Alpha Group here at JP Morgan. And today I'm really pleased to be sitting down with Andrew Tyler, who is head of our Global Market Intelligence team. Drew, thanks for being here to discuss markets again.
Oh, thanks for having me.
So as we sit here, it's the morning of Monday, March 3rd, and the U.S. equities have had a bit of choppiness, a little bit of a sell-off. We're approximately flat on the year-to-date basis, not a whole lot of movement, when we look back for the last couple of months, but underneath the surface, it feels like quite a lot has changed. So, Drew, given we're only a few percent from all-time highs, what do you think are the key reasons for this recent drawdown, and which ones do you think actually matter versus what's just noise?
Absolutely. So I'd first start with the weakening of the macro data. And so this kind of starts with the flash PMIs we saw about 10 days ago or so, really kind of coming below expectations. But then really more than that, the uncertainty that we have within policies. And so this is both the trade policies that we're still seeing kind of get adjudicated across the world, but also more of your domestic policies too. And then added to those two reasons, I would also say valuation to a certain extent, as well as positioning. And to add a little bit more color behind this, with the tariffs, or really the tariff uncertainty, we're starting to see this behavior impact the real world vis-a-vis businesses pulling forward some of their demand, as we saw kind of in recent macro data prints, which is also driving up inflation to a certain extent, but it's also that demand pull forward as businesses really just don't know what to expect. And from here, it's really the uncertainty around CapEx or capital expenditures, like how a business is going to spend its money to expand, but also hiring decisions too. Looking at these other latter points of valuation and positioning is certainly your domain, so let me not step on your toes there. But I think from a valuation perspective, what you've really seen in tech is kind of maybe went a little too far too fast. And whether this is DeepSeek trying to broaden out this AI trend, or just the absolute terms, S&P is a little bit too high, it felt time for a bit of a pullback. And so I really kind of point this question to you as well, just to see, what have you seen from a positioning standpoint over the last few weeks, and how has that really changed?
Sure. No, I think it's been an interesting one from the position dynamic, given obviously the sell-off has led to some amount of reduction in risk. And I think we see this most clearly amongst the retail investor, which was quite positive, very strongly post the DeepSeek news, actually, but now starting to reverse some of that bullish flow. And then also the more systematic investors. So when we look at CTAs, we've seen risk come in quite dramatically within the US equity space. And so I think those two are somewhat consistent with the pullback. There has been a little bit more hedging overall. We've seen hedge fund nets come down, especially in the last week. So overall, we're seeing positioning fall, and we're actually on a longer term basis now slightly below the 10-year average, which is kind of one of the first times we've seen this happen since early August of last year. So the level of positioning has certainly come in. I think what's still not clear, though, is how much has really been more adjusting to the uncertainty that you mentioned. So a lot of uncertainty leads to perhaps less risk-taking behavior in the near term versus what's actually been funds getting concerned enough that they are actually getting bearish, which could lead to a snapback if you get good macro data. So, I think we're still in this close to triggering maybe an attractive setup from the positioning standpoint, but not quite there yet, given the lack of real capitulation in the flows. So, Drew, back to you a little bit on this. As you think about what could maybe resolve some of this uncertainty, either positively or negatively, there does seem to be a lot of macro catalysts coming up in the next few weeks. So what do you think could matter the most as you look ahead in the next few weeks?
Yeah, absolutely. And before I answer that question, I think it's worthwhile to kind of understand that for our listeners, that in many cases, what you're looking for is a point in time where you have macro data that is good and getting better, because that will also pull up expectations for earnings. And then typically when you have macro data that's bad and getting worse, and you see those expectations move lower, that also negatively impacts stocks. So with that in mind, for this week alone, you actually have ISM data on today, Monday, again on Wednesday, but then it's really the non-farm payrolls print on Friday that is the most important print this week. And the reason why I say this is the ISM numbers could be slightly mushy, but as long as people have jobs, the expectation is that we will spend as Americans. And that's typically the behavior that we've seen. So I think that's the single most important data point we're looking for right now, kind of given that we have reached the tail end of earnings. But even with the earnings, you still have a couple of major semiconductor companies yet to report this week. And if both of those kind of beat expectations, you could really start to see the AI trade kind of come back a little bit. And that would really help the broader tech complex.
Also, I mean, maybe moving on from the very, very macro side, as you think about kind of which trades, which sectors could work. I know you've been generally bullish on TMT and cyclicals. Have your views around this changed given more of the uncertainty? And how much of that is just kind of a wait and see for the time being before getting back into those themes versus how much is actually you want to shift the portfolio a little bit more?
Yeah, no, absolutely. And so what I would say is that with the advent of DeepSeek, you've seen this AI trade broaden, and it's broadened outside the US. And so when you have like the China NPC this week, you might get a little bit more information that could actually draw more money into the China tech trade. So I think there is a wait and see to a certain extent. But when I think about US tech, I mean, I think that a lot of the drawdowns that we've seen in some of the single names are extreme enough that they make pretty attractive entry points for people that are looking on a little bit longer term basis than, like, let's call it a couple of weeks or maybe even a couple of months. So I think it's going to take a little bit of time there. But when we think about broader cyclicals, things like financials continue to attract money because this is a sector that for the most part is insulated from the tariffs. And I think that makes it unique in this time of round. That so like you think about some of your more traditional defensives, healthcare, consumer staples, and utilities. Well, utilities has been tied in the AI trade, so it doesn't really have the defensive properties we would normally exhibit. But then you start to think about some of your Mag 7 names. Some of them have, let's call it, operations and revenues that look like a bond. So I think there are some idiosyncratic plays within the Mag 7 that can be really fascinating.
That's really interesting. And I hear you on the financials bit. That's been one of the most popular trades for investors since really late last year when Trump's odds of winning the presidency started to tick higher. But as we've noted multiple times in the past, we still think that looks pretty attractive from a medium-term standpoint, given where positioning started from and sort of how much more could go from kind of the more longer-term complex. But if you think about those non-US views that you just mentioned, are you really thinking that those have a lot more legs to go? Because, I mean, one of the topics that's been most asked to me about has been how much have people repositioned into international equities? How much of that is coming at the expense of the US? How much more could go into those markets? So, I mean, how much confidence do you have that those trends we've seen at the start of this year, especially in Europe, as well as Chinese tech or Hong Kong equities, how much more do you think they could go in the near term or medium term?
That is the question of all questions. And so let me think about how I want to respond to this in the sense that, well, look, I think if we have the positive macro data from the US kind of this week, does that then kind of reboot tech? Because I think a lot of investors look at the US as really where you want to gain your growth. And when you start to see the tech sector fail to demonstrate that, then people are going to start to very rationally move outside the US for those opportunities. And so I don't think that I would be short any of the major regions that we've already spoken about, whether that's kind of China, Japan, most of developed Europe, or even some of the parts of LATAM. I just think that right now we are kind of held to basically having to watch what are the tariff headlines, and we might have new headlines coming out tomorrow. If we're able to get past that kind of unscathed, or let's say the tariffs come in below expectations, you're really setting the stage for areas that are the targets of tariff to continue to outperform. And I think that's probably the best trade right now.
No, that's fascinating. And I think it's one of those things that as we look at some of the positioning angle, the near term has certainly been quite positive into some of the European and sort of Hong Kong stocks. Mostly when we look at things like futures or systematic CTA positioning. But from a medium to longer term standpoint, the sense is that we haven't really seen that move as much. And that's what some of our longer term data shows. So I do think, depending on how these tariffs come out, if there is later than expected or sort of a bit more resolution around what the outcome could look like, perhaps you continue to see that repositioning into those markets. Is there anything else, Drew, that you want to kind of touch on in terms of near-term, medium-term catalysts and what investors should keep in mind?
Yeah, absolutely. One last final thing I would mention is the concept of seasonality. And so with seasonality, I would say that typically the first 2 weeks of March can be somewhat mushy versus if you look at March as the month and then combine this with April and May, that's actually the second strongest 3-month period of the year behind October, November, December. So I guess then the question I have for you is, like, are you starting to see any seasonal flows that would match what we've seen historically? And how does your view in the very tactical time period differ from like a little bit more kind of, let's call it 1 to 2 months out?
Yeah, thanks for that, Drew. I mean, I think in the very near term, some of the seasonal patterns do suggest, a bit of this retail seasonality is playing out as we've seen it in the past, but it doesn't necessarily hold back the markets. I do think in the near term, if we get a little bit of a positioning flush, or if we get a reacceleration on the macro data, to your point earlier of it's good when the data is good and getting better, and it's not great for equity investors when the data is bad and getting worse. I think the same thing sort of holds true from a positioning angle. But right now, the medium-term trend, so short-term, I think, get a little bit of positioning flush or clarity around the macro, and we could go higher again, and people could take a bit more risk. I think in the medium term, i.e. next couple quarters, the trend is a little bit still mixed. And I say this because the positioning trend has been high but getting lower, versus if you look back to last year when the macro data was getting better, it was generally quite bullish and had been getting higher for the past couple of years. And so this could mean, over the next couple quarters, a greater odds of a more material sell-off if the data actually turns. But I think still in the next couple of months, the expectation would be equity markets hang in there, assuming the macro data doesn't actually deteriorate that quickly. Positioning reaccelerates a little bit or stabilizes at this point. And then we'll have to see in a few months if that trend in the broader macro story is actually weakening and if clients need to kind of reposition a bit more to the downside or protection at that point in time. So maybe just to wrap up kind of what we discussed, Drew, at the moment, the macro data is a little bit challenging. You do see some reasons why we could say a little bit more cautious in the very near term, but as you just kind of mentioned around the seasonal points, if the macro data holds up, you would be still bullish on markets over the next couple of months in the US. But I think one of the more interesting things that's been happening is this broadening out of the trade beyond just the clear AI winners in the US to a more global rally. And you think that has some legs, especially if we get some more clarity around tariffs that isn't that negative. And I think from a positioning side, this sort of matches well, which is in the near term, we've seen some risk reduced, not enough to call a clear kind of you should buy the market based on positioning being reduced quickly. But we could see that happen if either we get a bit more of a flush or if the macro data this week comes a bit more positive and reignites some of that risk sentiment in the near term. With that, we'll wrap up. And Drew, thank you again for sitting with me and chatting.
Oh, it was great seeing you, John.
It's great being with you. And thank you also to our listeners for tuning into this bi-weekly podcast series from our group. If you have feedback or if you'd like to get in touch, please go to our website, jpmorgan.com/market-data-intelligence, where you can send us a message via the Contact Us form. And with that, we will close. Thank you.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, and YouTube. The views expressed in this podcast may not necessarily reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan, and do not constitute research or recommendation advice or an offer or a solicitation to buy or sell any security or financial instrument. They are not issued by JP Morgan's research department, but are a solicitation under CFTC Rule 1.71. Reference products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. The FICC market structure publications, or to one, newsletters, mentioned in this podcast are available for JP Morgan clients. Please contact your JP Morgan sales representative should you wish to receive these. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures.
Copyright 2025 JP Morgan Chase & Company. All rights reserved.